Hello and welcome to Basic Tax Training for Tax Sales Representatives. My name is Jason Bowman. I'm a IRS licensed enrolled agent, and we are going to be going through for the next 20-30 minutes or so the really basic things that any tax sales representative needs to know about taxes. The things that we're going to be covering are applicable to anybody that is selling tax preparation services, tax resolution services. So if you're an opener or closer in the tax resolution industry, this information is important. If you are an appointment setter or callback setter for a tax attorney, a CPA, an enrolled agent, then you're scheduling consultations or callbacks for any kind of tax services for tax professionals. This kind of knowledge will help you in that task. And even if you're not a sales representative, but if you're a receptionist that occasionally talks to new prospective clients, this information is just as valuable to you. So, as a tax sales professional, why do you need this knowledge? First of all, if you sound like you don't know what you're talking about, you immediately lose all trust with a prospect, okay? So you need to sound like you know a little bit about what you're talking about, and that helps to build trust. Winning the trust of the prospect begins with competency. You need to be able to talk tax. You need to be able to intelligently discuss some basic tax concepts. Okay. Even more importantly, for the sales professional that is responsible for closing, the fact of the matter is that if you're doing a proper needs analysis with a prospect, you have to have tax knowledge. That's just not negotiable. Proper needs analysis, what I call consultative selling, it requires proper tax knowledge so that you can recommend the appropriate products and services to your prospect. So let's first of all talk about entities. Now, some of this stuff I'm fully acknowledging is going to be basic, and you're going to probably wondering why I'm covering it, okay? But there is a purpose. So, first of all, entities that are taxed. Who pays taxes? Well, basically in the United States, everybody. The old joke, the only two things that are guaranteed are death and taxes. Well, the thing that you need to realize is that as we talk about tax types and filing deadlines and things like that later on, the entity being taxed matters, okay? So first of all, individuals. People, couples, children can all pay taxes. Yes, even children can have taxable income and investments and stuff like that. Corporations. Corporations pay taxes. I realize that there's a joke in our society that corporations don't pay taxes. However, here in the United States, we have the highest effective marginal income tax rate for corporations in the entire world. A lot of people don't realize that. Corporations can be of different types. Here in the United States, we also have what's called a Subchapter S corporation. This is a small corporation that files a Form 2553 to be elected to be taxed as a small corporation. There are limits on the revenues that a sub S corporation can have. They have to have less than $10 million in revenue. They can't have more than 25 shareholders. They're meant to be small, mom and pop, family owned, type businesses that don't necessarily need all the extensive reporting requirements of a larger corporation. Okay. A Subchapter S corporation is also nice because it's what we call a pass-through entity. A C corp has this double taxation thing that goes on. So basically, a C corporation, the corporation pays corporate income tax on the profits, and then the shareholders have to pay taxes on their dividends as well. So there's a double taxation on the same piece of revenue. Whereas in a subchapter S corporation, a sub S corp does not pay regular corporate income tax. The corporation can pay other types of taxes for different events, but in the normal course of speaking, doesn't pay an income tax itself. Rather, the profits flow through to the shareholders and they're taxed at the individual level. Okay, that's the beauty of the S corp. Limited liability companies. These have become really popular in the past 15, 20 years. Every state in the union now has some sort of LLC offering. LLCs are interesting from an IRS perspective because the IRS doesn't recognize the quote-unquote LLC as a specific type of entity. The IRS will default classify for tax purposes, for federal tax purposes, an LLC based on how many partners or shareholders there are. So if you form a LLC in your state, and most states allow to have what's called a single member LLC, so that you get liability protection, in the form of a legal entity, but in the eyes of the IRS, a single member LLC is still a sole proprietorship. Okay, a two-member LLC in the eyes of the IRS is really a partnership. If you have more than two members in an LLC, then the IRS default classifies the LLC as a corporation. Now, you can make an election to change the default classification, but if you don't, that's what you're stuck with. And you have a limited time frame in order to make the election. And you can actually have a single member LLC that you file the paperwork with the IRS to have it treated for tax purposes as a subchapter S corporation. And there's various reasons why somebody would want to do that. There are tax advantages to doing so. That's personally how I set up my own companies. But that sounds weird to some people, but those are the default classifications for an LLC and the different things you can do with them. Partnerships. Partnerships are just that. They are two people or two entities or a person in an entity that are working together in a joint venture, and they have a partnership. The professional corporation in the majority of states is a special type of corporation. It is limited to medical practices, CPAs, law firms, service-oriented professionals. They're kind of an interesting entity because they don't have, in most states anyway, they don't have as much liability protection as, say, an LLC or a corporation does. And in some states, certain professions are required to set up and operate as a PC. So that's something to keep in mind. Next is a nonprofit. And a lot of people don't realize this, but at the state level, nonprofits are usually corporations. So they're a regular corporation, just like any other corporation. And the nonprofit part only comes into play when you're talking about state income tax, sales tax, federal income tax, different excise taxes, that sort of thing. So bear in mind that a nonprofit is still usually a corporation. In some states, they can also be an association, which is a separate entity type. But usually they're corporations, just like any other corporation. So your local United Way is most likely a corporation, just like your local enterprise car rental operation is a corporation. Okay, so that's a little bit of information about entities. Let's talk about tax types. First of all, income tax. And what you see on the screen here are the different forms that are filed to report income tax. Okay, so individuals and married couples, families, head of households, they use a Form 1040, which is broken down further into 1040EZ, 1040A, or 1040 long form to report their income taxes every year. C corporations file an 1120. Subchapter S corporations file an 1120S. Partnerships file a Form 1065. And nonprofits, if they're a 501c3 or 501c4 or other type of IRS recognized nonprofit organization, they file this massive, it's 20, was it 25, 26 pages, this massive tax return every year called a Form 990. And most of the questions on the form, literally there are hundreds of questions on this tax return. They're a nightmare to fill out. Most of the questions pertain to making sure that the nonprofit organization is actually operating as a nonprofit and not just as a cover to avoid paying taxes. This Form 990T that you see right here, the 990T is a business income tax return filed by a nonprofit for reporting revenue and paying tax on business activities that are not part of the nonprofit mission, and so the nonprofit still has to pay taxes on those business activities. A great example that is actually fairly common, it seems, would be, for example, a for-profit coffee shop set up inside of a museum or a church or something like that, where the coffee shop generates a profit, and so they got to pay taxes on that, even though the money does go to support the nonprofit organization. Next thing to look at are employment taxes. These are filed on Form 941 for quarterly filers, and there are some businesses that can get away with filing an annual employment tax report, and that's a Form 944. Employment taxes are income tax withholding that is withheld from employees' paychecks. It is also Social Security and Medicare that is withheld from employee paychecks, and the matching portion from the employer. So those are the taxes that are reported on that form. Unemployment taxes. This is Form 940. This is filed once a year. Unemployment taxes are exactly that. They're what fund, for the most part, the unemployment compensation system in this country. And the way it works is that the first $7,000 of every employee for the year, the first $7,000, you pay a small percentage of their wages into this unemployment fund. The thing about employment taxes and unemployment taxes is that they are a pay-as-you-go system. If you are an employer and you have employees, then with your regular payroll cycle, when you issue paychecks to your employees, you have to make what are called federal tax deposits to deposit the money to the Treasury Department that you withheld from paychecks and your matching portion of the Social Security and Medicare. If for the employment taxes, if the amount you owe is less than $2,500 a quarter, you don't have to make these federal tax deposits. That's kind of a loophole for smaller employers with usually only one or two employees. They can do that. But if your tax liability for a quarter is going to exceed $2,500, then you have to deposit them usually either bi-weekly or monthly. Unemployment taxes, if your unemployment tax bill is going to exceed $500 for the entire year, then you also have to make regular federal tax deposits. If it's going to be under $500 for the year, you can just pay it with the return at the end of the year. There's other types of taxes that are filed on different forms, and this is actually a typo. This should be a form 2290. The most common excise tax return that we deal with is the heavy vehicle highway use tax, and this is basically an excise tax for having large trucks on the road. So if you are talking to truckers or construction companies, anybody that uses heavy equipment or heavy vehicles that are on the highways, this is a tax that they have to pay that goes into the highway funds. State, local, and county governments, a lot of times, in most states, will also have sales taxes. There is no federal sales tax at this point in time. And sales taxes are paid on purchases. Use taxes are something that most people don't hear about, but use taxes at the state and local level are taxes that are paid or are supposed to be paid. Use taxes are probably one of the biggest areas of tax evasion in the entire country at the local level. But use taxes are the equivalent of a sales tax that you should pay for using tangible property, either in your business or in some states, even personal property, that you bring in from somewhere else. A common example would be a business that operates, say, in Washington, which has Washington State has a fairly high sales and use tax rate, but a business purchases a computer in Oregon. Oregon, across the river, doesn't have a state sales tax. So someone goes across the river to Portland, buys a computer, takes it back to Vancouver, for example, to their business. And so they didn't pay sales tax on it in Oregon, but they're using it in Washington. Well, Washington's going to come back and say, you have to pay use tax on this because you brought it into the state from somewhere else. And like I said, it's a completely voluntary compliance system, and it's probably the biggest area of tax evasion in the United States because it's so hard to track. But local use taxes for local small businesses, if they get audited by the city or county, they can be a nightmare situation. Let's talk about filing requirements. Most of the income tax returns that we already talked about have an annual filing requirement. Most people know that April 15th or the business day following thereafter is the deadline for filing their 1040. Corporate tax returns and partnership tax returns are usually due on March 15th. The actual regulation says the 15th day of the third month following the end of the tax year. So for businesses that operate on a calendar fiscal year, that date falls on March 15th. Those 990 and 990T tax returns for nonprofits we talked about, those are due on the 15th day of the fifth month following the end of the fiscal year. So for most of them, that falls on May 15th. Quarterly returns, those 941s, those are due at the end of the month following the end of a quarter. And in case you don't know how quarters are broken down, real quickly, the first quarter of a calendar year is January, February, March. Second quarter is April, May, June. Third quarter is July, August, September. Fourth quarter is October, November, December. So the first quarter, 941, for a business with a calendar year, fiscal year, when is that 941 due? It's due at the end of the following month, which would be April. The second quarter return is due at the end of July. The third quarter return is due at the end of October on Halloween. And then the fourth quarter return is due at the end of January of the following year. Also due at the end of January is that 940, that unemployment tax return. Also due at the end of January to the recipients are your W-2s and 1099s. So if you've had a job, you are used to knowing that you have to get your W-2 from your employer, before the last day of January. Well, as an employer, you have to then file a copy of that W-2 and the 1099 with the IRS and the Social Security Administration for W-2s before the end of February. Something very important to note, too, for your purposes as a sales rep is that there's a form called a W-3. And what a W-3 is it's a kind of a summary and reconciliation of all the W-2s that you file. A Form 1096 is a summary and reconciliation of all the 1099s you file. The reason that this is important is that there is a huge penalty associated with your W-2s, W-3s, 1099s, and 1096s not adding up to your 941s. This is a huge area of compliance that the IRS goes after because it's easy penalty money for them. Because it's all computer matched. They don't have to actually have anybody look at anything. They just do the computer matching, they kick out a penalty notice, and send you a bill for thousands of dollars. So I hope that makes sense, because your quarterly 941s show all your payroll for the entire year for all your employees. Your 4 941s for the year added up should equal the sum of all your W-2s, which should equal your W-3. So there's a mathematical correlation between those numbers, and then also your total payroll should also match what's shown on your 940. So there's a big mathematical correlation between the 941, the 940, and the W-2 and the W-3. And if there's any mismatch between those, it'll create what's called a CAR assessment, CAWR. It's an acronym for, I don't remember exactly what it is, but it's a something wage reconciliation. And so those CAR assessments get kicked out by computer automatically. Other types of returns have different deadlines. There are literally hundreds of different tax returns that you've never heard of, and that you don't normally deal with, that have to do with excise taxes for the most part. The most common one is that heavy vehicle highway use tax return, that Form 2290. The Form 2290 tax year runs from July 1 through June 30th. So you have to file that return and pay the tax on it by the end of the month following the month in which you place a vehicle in service. So if you've got a piece of heavy equipment that runs along the freeway, and you put that vehicle, and you've had it for a while, so you do this every year, and it's still in service come July 1st of 2011, then you have until the end of August of 2011 to file the return and pay the tax for having that vehicle on the highway. Okay? Now let's talk about penalties and interest. This is where things start getting interesting for us in particular. Penalties and interest that the IRS charges are incredibly egregious. And the reason that they are so high is to encourage compliance. Okay? This is an enforcement mechanism, just having the threat of all these penalties out there. First of all, the failure to file a tax return, first of all, let me back up. When it comes to the IRS, they are more concerned about somebody filing the return than they are about paying the tax. The reason for that is because if you don't file the return, they don't know how much to charge you. Okay? So to them, filing the return is more important than paying the tax. Because at least if you file the return, they know how much of a bill to send you. So there is a failure to file penalty that is 5% of the amount due on the tax return per month. And that caps out after 5 months. And there's a $135 minimum charge for that. So after 5 months, it caps out at 25%. There's also a failure to pay penalty that's 0.5% per month that goes up to 1% per month after they send you a notice of intent to levy, which we'll talk about here in a minute. That's what the CP 504 is. And this also has a 25% cap. So you can see that the failure to file penalty maxes out after 5 months. The failure to pay penalty can max out in as little as 2 years if you're at this 1% rate. And then if we're talking about, in particular, 941 and higher 940 taxes, and you don't make those federal tax deposits, for every day late that you are late making a federal tax deposit, the first day it's like 2%, a few days later it goes to 5%, then it goes to 10. After 10 days, if you have a federal tax deposit that is due, if let's say you're a monthly depositor, so the deposit's due on the 15th of the month, and you don't make that deposit until the first of the following month, you're more than 10 days late, bam, you've got a 15% federal tax deposit penalty. Now, let's think about this. In terms of tax resolution in particular, 941 employment taxes are the most common tax type that we deal with, where a business needs help getting that resolved. Well, if they've gone through the cycle and they didn't take care of it for 2 or 3 years, which is pretty common, well, they've maxed out this penalty, the failure to file. They've maxed out the failure to pay, both that 25% cap. They've maxed out the failure to deposit penalty. So all of a sudden, if they didn't file the return on time, and they didn't pay it, and they didn't make the deposits on time, which obviously they didn't in this case, the total penalties can add up to 65%. So if that bill was, only a few $1,000s, they've now more than doubled it. Okay? That's why the penalties are so egregious. Now, tack on top of that, you got to pay interest on all this stuff too. The IRS charges interest at the rate of the federal short-term rate plus 3%. Currently, it's 3.51% as of the time I'm recording this. And here's the kicker, though. That interest is compounded daily. All right? So interest charges by the IRS can add up pretty quick, too. So these are the most common penalties that you're going to talk about. And the 65% number, that's the big, scary, you just doubled your tax debt number. This is really important, from a sales perspective to keep in mind. Now, there's some other penalties, too. If you intentionally understate the amount of your tax, they'll whack you with a 20 to 40% penalty. Those information returns that we talked about, the W-2, the W-3, 1099, 1096, if you file those late, they can charge you a penalty of up to $50 per form. Partnership documents, S-corporation documents, if you don't file your K-1s and some other information on time, they can charge you a penalty of up to $195 per month per partner, and there's no cap on these penalties either. So a couple years down the road, you've got a couple, $2,400 a year penalty adding up, per partner. That can be pretty stiff too. There's a very special penalty out there that we deal with quite a bit that stems from those employment taxes. The IRS is they prioritize their resources just like any entity does. And the single biggest priority for enforcement for the IRS is what are called trust fund taxes. And that word trust fund, if you've listened to the debate about the Social Security trust fund being bankrupt and all that, we're talking about the same trust fund. The Social Security and Medicare taxes and the income taxes that a business owner is responsible for withholding from employees' paychecks, those are collectively referred to as trust fund taxes. So let's say the business owner doesn't withhold that money and send it to the IRS. Well, the IRS has this trust fund recovery penalty. It is a penalty equivalent to 100% of the income tax withholding, Social Security, and Medicare. It does not include the employer's share. It's just the employee's share, which is the majority of it, because of the income tax withholding. 100% of that money that the business owner hasn't paid over can be personally assessed as a penalty against an individual. It is an automatic, administrative, non-judicial. They don't need to go to court for this. It's administrative. It's a piercing of the corporate veil, and it's a pretty simple process by the IRS. In the tax resolution side, we do a lot of trust fund recovery penalty representation when you're dealing with 941 taxes for businesses, which are the most common tax type. The IRS has to demonstrate that the individual was both responsible for withholding those taxes and willfully failed to do so. So a lot of times it ends up falling on the business owner, a manager. Sometimes a bookkeeper can be held responsible. This is a dangerous penalty because this goes against the individual personally. So what happens when somebody doesn't pay their taxes? Well, you start getting nasty letters from the IRS. And the further down this chain you go, the longer you wait, the worse the letters get, and the scarier things can happen. The nice thing about IRS notices and letters, the IRS is a bureaucracy. They do everything on a system. And so whenever you get a letter from them, they put a number on it. And that number corresponds to what it is. So it's really, really convenient for us because we have a client that can bring us a stack of letters and we know what they are and what we can do with them. So the first thing that you get is what's called a statutory notice of deficiency. This is basically the first bill. We call it, just kind of in lingo, we call it a 21-day letter because the statutory notice of deficiency, which can have different letter numbers attached to it. The most common one that you see is a CP21B. But this 21-day letter is called that because once you get it, you've got 21 days to pay the bill without incurring any additional penalty and interest charges. Okay? If you miss the 21 days, you'll probably get a couple more bills that pretty much look the same. After 2 or 3, 4 months, you'll get kicked over to the automated collection system of the IRS. And the next scary looking thing that gets sent out is called a CP504. This is a notice of intent to levy. A levy is the IRS's legal authority to take your stuff. Okay? And typically when we talk about levies, we're talking about cash. So a levy allows the IRS to dip into your bank account, dip into your paycheck, dip into your accounts receivable, and literally take money out of your pocket. So this is when things start to get scary for people that owe money to the IRS. A CP504 itself doesn't have any teeth, okay? But 30 days after the CP504, you're most likely going to get a letter 1058. This is a final notice of intent to levy, which also has a 30-day wait period on it. And after that 30 days, the IRS can levy you. The nice thing about the 1058 is that it has appeals rights, and we can file administrative appeals. It's called the collection due process appeal, to stop that proposed levy action and buy time for the client. And a lot of times we can get tax cases entirely resolved within the appeals process. I'm a big fan of appeals. Some other things that are going to be out there. A Form 668Y. This is a notice of federal tax lien. This, a tax lien can come at any time, before, after, during a letter 1058. The IRS will usually file a lien against a business or a person after they've owed a tax liability for 4 or 5, 6 months. But sometimes it takes them 2 years. Sometimes they never file it. But the majority of the time it'll happen well within 6 months through an automated system. A Form 668A, this is usually what follows the letter 1058 if you don't respond to it. If the IRS knows where you bank, or if they have information regarding your customers, your accounts receivable, they will send levy notices, this Form 668A, to your bank or to your accounts receivable and require them to send money to the IRS. The way that works with the banks, bank receives it. The day on which they process it, they're required to freeze all funds in your account as of that day. They take the money out of your account and they hold it for 21 days. And then they have to send it to the IRS. The 21 days gives us time to get the levy released. We have a 3-week window to get the IRS to release the levy and redeposit the funds back into your bank account. The interesting thing about that is that it's only impacting the funds that are in your account on that day that it's processed. So if your bank processes a levy on the 3rd of the month, you can literally make a deposit on the 4th of the month, the very next day, and those funds are okay. Those are still yours. They're not going to be held by the bank. An accounts receivable levy, if you have a customer, if you're a business and you have a customer that owes you money and they receive a levy, they're legally required to send that money to the IRS right away. There is no 21-day hold on that particular case. A Form 668W. This is a Notice of Continuous Levy on Wages. This is for 1040 tax liability, individuals. And the thing that's scary about this is you filed your tax return, it's got your W-2, the IRS has your W-2, therefore, they know where you work. If they know where you work, they know where to send the levy on your wages. We call this a levy on wages. Most people call it a wage garnishment. The scary thing about an IRS wage garnishment is that there's a table that your employer uses based on the information on your W-4 that shows your withholding allowances, your dependents, your spouse, kids, whatever. And based on how many withholding allowances you claim, that determines how much of your paycheck you get to keep. Not how much they take, but how much you get to keep. If you're single with no dependents, that chart says that you are allowed to keep $168 a week of your paycheck. So even if you make $50,000 a year, you're only going to get $168 a week out of your paycheck if there's a wage garnishment in place and you're single with no dependents. Personally, I don't know anybody that can live off that, especially if you have a family, you've got rent, a mortgage, food, car payment, all that stuff. A wage garnishment will literally kill you. This is a very, very, very serious enforcement tool that the IRS uses probably too frequently. And so as a sales rep, you need to understand that if you're talking to a prospect about coming on board, to get assistance from you, if they've got a wage levy, that's serious. That is very, 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 very serious because it is impacting their ability to put food on the table, gas in the car, keep the roof over their head. An IRS wage garnishment is nasty. It's really, really nasty. So what options does a taxpayer have to resolve a tax liability? This information, if you're selling tax preparation services, then this information is still useful to you because if a tax return is prepared and it's got a liability on the bottom line that the taxpayer can't pay, then these options can be addressed from the get-go rather than 3 years down the road. The most common resolution option is what's called an installment agreement. This is simply a monthly payment plan. If the taxpayer is an individual that has less than $10,000 in income tax debt, great. There's this thing called a guaranteed installment agreement. They don't even have to provide financial information. They can propose a payment plan. As long as it's reasonable, the IRS is required by law to accept it. If it's an individual or a business with less than $25,000 in income tax debt, there's what's called a streamlined installment agreement, which requires very little financial disclosure. They're pretty easy to get. They're pretty quick things to resolve. If they owe more than $25,000, or if it's not income taxes, then we have to do just a regular installment agreement. This requires full financial disclosure. There's a lot of paperwork involved. This is when we get into nitty-gritty negotiation with revenue officers and things like that. There is something called a partial payment installment agreement, and the IRS doesn't like doing these, but we can get them if the financial situation warrants it, and if you've got a good negotiator working on behalf of the taxpayer. The PPIA, partial payment installment agreement, it's just that. It's a monthly payment plan where the tax liability doesn't get fully paid off before the statute of limitations expires on collection of the debt. And this is a good time for me to tell you about the CSED. The IRS has 10 years from the date that taxes are assessed in order to collect them. There are things that can stop the clock and therefore extend that 10-year period, like when you file an offer in compromise or something like that. But in general, it's 10 years. So if somebody files a tax return, let's say they filed their 1999 tax return, they filed it April 15th of 2000, the tax return doesn't get processed right away. Let's say it doesn't get assessed until June. So June 2000, they get assessed with the tax liability. Well, if they don't do anything else, they didn't do anything to delay it, they didn't file appeals, they didn't file an offer in compromise, things like that that extend that period, then come June of 2010, that tax debt went away. Just poof, disappears. So if you get on a payment plan and run out that 10-year period, then the rest of the tax debt literally just goes away. Another option is what is called currently not collectible, CNC for short. If a tax negotiator can demonstrate on paper that the taxpayer is broke, they have no significant assets and insufficient income to address the tax liability, then we can get them into the CNC status. Penalties and interest still accrue, and this period typically only lasts for a year to 18 months, but it gets the IRS monkey off your back and gives you time to figure something out. Okay? This is a great option for businesses that expect to recover financially and revenue to increase. It's also great for individual taxpayers if they're unemployed, but they expect to get a job later on. Next is the offer in compromise, the OIC. This is what you hear referred to as the quote-unquote pennies on the dollar operation. The thing is that a lot of tax resolution companies will sell this to everybody. Problem is, the vast majority of taxpayers are not eligible. Okay, there are strict eligibility criteria. It requires a full financial analysis, and the amount of the offer is not some weird percentage of the amount that's owed. The offer amount is actually based on how much assets they have and what their disposable income is. There's a formula for arriving at the offer number, and it's a formula set by law. Okay. When it comes to negotiation for an offer in compromise, what we're negotiating is actually the inclusion or exclusion of assets and the inclusion or exclusion of income and expenses. That's what actually ends up being negotiated on the taxpayer's behalf. The offer in compromise is a long process, 6 to 12 months. Year-long process is not uncommon. The beauty of the offer in compromise is that it prevents any other enforcement action. No levies, no wage garnishments, none of that stuff's going on. However, the statute of limitations on collection, the CSED, it gets extended for however long you're in this offer in compromise status. So that's a downside to it. So those are the three major tax resolution options. There are a bunch of other things that can happen, quote unquote, advanced strategies. Things that I've done, I've negotiated levies. So, negotiated a continuous levy against accounts receivable for a certain amount. The first several $1,000s of an accounts receivable that gets paid every month to a business by another business. There's also things that we can do with assets. There's things that we can do with the lien. We can get assets discharged from a lien so that they can sell the asset so they can pay the tax. There's things that we can do with the lien to allow a business to factor their receivables. Basically, factoring is essentially a process. It's almost like a payday advance loan, but for a business on their receivables. Doing things to delay collection action, like getting into not collectible status, and then taking advantage of all the different things to basically keep the IRS at bay. We can basically let the CSET expire, and so if you wait long enough, the tax debt goes away. And so basically you can play cat and mouse with the IRS for long enough and the tax debt will go away. That is sometimes an option. Another thing to consider, if you amend tax returns to correct wrong tax returns, it can drastically drop the tax debt sometimes. And there's a bunch of other things that we can do as well that get into some fairly complicated maneuvering to make things happen. As a salesperson, if you're selling tax preparation, and the person knows that there's going to be a liability owed, then you may want to bring up some of these options. The installment agreement is probably going to be the most common one, but you should be able to talk intelligently to a tax preparation customer. If we're going to do a corporate income tax return for them, and they're a C corp, and they know that they're going to owe $100,000 in tax liability, then you need to be thinking about their resolution options from the get-go, because it's going to make the penalties a lot smaller if you address it now rather than if they address it several years down the road. So, how do things work when somebody owes tax debt and they hire a tax professional to resolve the situation for them? So here's what happens when we take over. First of all, we file a power of attorney. This is a standard IRS form 2848. The power of attorney gives us legal authority to act in the taxpayer's behalf. Here's what we do with that authority. First thing that we do is we get account transcripts from the IRS. These transcripts they're almost like bank statements in a way, but they show the transaction history on your IRS accounts. So we order these transcripts when we do a review of them. What we want to do is we want to verify that you actually owe the tax that the IRS says you owe. That's probably an overlooked step. People just automatically assume that the IRS is correct. Never assume that the IRS is right, because you'd be amazed at how much stuff they screw up. We also want to look for any outstanding tax returns. This is something as a salesperson that you should ask about. If you are selling tax preparation services to customers, it's 2011. So we're talking to them about doing their 2010 returns. Well, also ask them, hey, are you missing your 2007, 2008, 2009? Did you get those filed? Okay, great. If not, hey, we can help you out with that. Same with quarterly employment tax returns. If they haven't filed them for a while, they've got to get them filed. Otherwise, the IRS won't even talk to you about resolution if you have unfiled returns. So we got to find out what tax returns are missing. Ask the customer about it, but also we can find it on the transcripts. We also will look at the current year, the current quarter, for businesses. Are they current? So have they been making their federal tax deposits? If they're an individual and they're self-employed, are they making their estimated tax payments? If a self-employed person is not making their estimated tax payments, or if a business with employees is not making their federal tax deposits, the IRS won't talk to you. Two very, very important things. They've got to be, and we call it current and compliant. They have to be current with federal tax deposit requirements, and they have to be compliant with filing requirements for filing everything. So those are the two first things that we always do. We got to get them current and compliant. So we look at the transcripts to see what they're missing. The next thing that we do is a very, very thorough financial review. This is a place where a lot of tax resolution customers will start to balk. Okay, the type of information that we need is very, 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 very similar to the kind of information that a bank would need if they were applying for a loan. Okay, so a commercial loan or for a mortgage, something like that. We're talking, we need profit and loss statements, we need bank statements, we need copies of tax returns, we need pay stubs, we need mortgage statements, all sorts of very private financial information. And here's why. And this is how I like to explain it to customers, okay? If you owe the IRS money, in the eyes of the government, you have taken an unauthorized loan from the U.S. government. And so basically we're doing a loan application. That's why we need all this information. So the interesting thing about the financial review from my perspective as an enrolled agent is the financial review is where the resolution options come out of. So if the tax attorney, the CPA, the enrolled agent that is negotiating on behalf of the taxpayer is looking at all this financial information, it will form a picture of what the taxpayer is eligible for in terms of IRS programs, and also what they can afford to do, period. Okay, so the financial review is where the resolution options come out of. And the next step's the resolution. Like I already mentioned, they have to get current with federal tax deposit requirements. They've got to file miscellaneous returns. And then we propose a resolution to the liability, whether that's a payment plan, non-collectible status, having fun with assets, doing lien work, an offering compromise, whatever the option is that we take, we have to propose that and negotiate it. And then in cases where an installment agreement is negotiated, or there was an asset transfer type situation, then we will look to see, was there a reasonable cause for the taxpayer not paying the tax debt when it was due? And if there was, then we can file an application for abatement of penalties. Interest is not able to be eliminated. You cannot get rid of interest. But the IRS does have some extensive provisions for applying for penalty reduction. The cool thing about this, if they've paid off the tax debt through, say, like an asset transfer, and we get a penalty abatement approved, then they actually get a refund, which is always cool. The next step is putting the taxpayer into a situation where they stay out of trouble in the future. We have to put them onto a plan for staying current and compliant. For a business with payroll tax liabilities, this almost always means getting them set up with a payroll service. If they've had issues with not filing their returns on time, then we need to get them into a tax preparation service that reminds them, hey, we need to get your taxes done. If it's a self-employed person, we'll do up their 1040 ES vouchers so that they can make their quarterly estimated tax payments. Okay, and then as an optional service, at the end of things, we can for an additional annual fee or something like that, or a monthly fee, however your company works with it. we can offer a monitoring of their tax accounts. So basically, we keep a power of attorney open. We get copies of any notices that the IRS sends out. Do a monthly or quarterly or annual whatever review of the transcripts, and to monitor their tax accounts and inform them of what's going on, advise them of what's going on. And this is a often missed additional sales opportunity for tax practitioners. So if you're a CPA enrolled agent or tax attorney that's listening to this, think about pricing and structuring a tax account monitoring service for your customers. So that's what I had for you. I really hope that this was some good information for those of you that will be either openers, closers, callback setters, appointment setters, be it for tax preparation services for a CPA or enrolled agent, tax resolution services for CPAs, EAs, tax attorneys. And this information is even good, even if you're a bookkeeper, and you're looking at, maybe hooking up with a CPA or enrolled agent or tax attorney to offer services that require a license, and you're going to be selling those services to your existing clients. This is also good information for you. So I really hope that you were able to get something out of this, and that this information is beneficial to you in terms of your professionalism and your competency for discussing tax matters with your prospective customers. My name is Jason Bowman, and it has been a pleasure going through this presentation. Have a wonderful day.